over summer weekends with market volatility at its wicked best. The week saw some solid data from both UK and the US, and while sterling reacted positively to good data, the US dollar however was mixed and to some extent confounding the principles of trader reaction. Weekly jobless claims in US came in at multi-year lows, which led to a sell-off in bonds and precious metals. And understandably so, as employment growth is the best indicator of a recovering economy. However, what baffled many was that equities also collapsed, with both Dow Jones Index and the S&P 500 registering sharp falls. And the greenback, which is how the US dollar is called, also fell. This was one of the biggest breakdown of correlations. When one looked a little closer and analyzed the data releases in detail, it would have been observed that the tick data, which is an indicator of capital flows into the US, showed that two of historically biggest bond-buying nations were net sellers during the period under review. Both China and Japan reduced their bond holdings by $40 billion. Why? The market wondered. At a time when especially Japan is running a quantitative easing program, its reducing of US bond holdings appears to run contrary to its intention, as the JPY will strengthen as BOJ repatriates bond proceeds, unless it decides to hold dollars in cash or reinvest in another currency. Whatever, in the short run, there is some uncertainty. On a slightly administrative note, speculations are still rife about who will be at the helm of the Federal Reserve Board once Ben Bernanke. Let us look at emerging markets this week. Emerging market currencies, Indian rupee, Turkish lira and South African rand have come under severe selling pressure ever since the May FOMC meeting, when the taper talk first surfaced. What happens when Fed tapers? Theoretically, leveraged investors will unwind a carry trade. It is of great relevance that only the three countries, namely India, Turkey and South Africa, are seeing the worst of their times, economically. Why? The basic economics comes into play. A country that has a structurally negative trade balance becomes weaker when its ability to attract capital flows weakens. Let me take the example of India this week. India is one of the Asian tigers, popularly called as a BRIC country, an acronym for Brazil, Russia, India and China, due to its strong growth close to double digits in the mid-2000s. A strong demographic advantage, cheap skilled labor, a superpower in information and technology, an opening up economy, stable exchange rates and a country of vast natural resources, India was a natural destination for global investments. Foreign institutional investors and foreign direct investment have grown by leaps and bounds as high-yielding bonds and an outperforming stock market was what every investment manager of the globe wanted. Spicing it up with the fact that cheap money is sloshing the world financial markets, India has been in focus in the last 4 years. What has turned negative now? India, on account of its excessive reliance on global crude supply, has been a net importer on an annualized trade basis. Gold and commodities are other major products that form the import basket. India's main exports are IT and services. As global economy slowed and went into near recession in the last 4 years, India's export growth had slowed down too. Strong domestic consumption, however, kept the import bill running high. As a result of this, its net trade position or deficit stands at record highs as a percentage of GDP. While this is not abnormal, it has to be remembered that US or Australia are structurally trade deficit economies. A weakening currency is adding to its woes. Especially since May FOMC, when the talk of tapering of bond buying started, there has been accelerated outflows from Indian markets. The currency, INR, has weakened from 57 to 60 in less than 3 months and in the year, by nearly 20%. Apart the weakness, it is the volatility that is of greater concern. Such strong depreciation has its big impact on inflation. As can be seen in the various inflation data, India's CPI and WPI are stubbornly high. The Central Bank, Reserve Bank of India, has introduced a number of measures in recent times, complemented by the Government of India. ranging from increasing import duty on import of precious metals to restrictions on the quantity of import of gold to capital controls like restrictions on outbound investments by resident Indians. The country is doing everything possible to arrest the weakening currency trend. Will this suffice? Technically, at least, INR is due for a reversal as seen below. What does the future bode? On a REER, real effective exchange rate, model, Indian rupee is the most underperforming currency of the year. Such unidirectional weakness tends to get reversed. Coupled with the measures recently taken, there is hope for the India-destined investor. The currency may recover and correct from its all-time lows in the coming months. Structural changes are however still required. India gets a new governor for RBI. Change at the helm and an expected issuance of foreign currency bonds may turn the tide in the short term. While we watch the developments with keen interest, I sign off here with promise to return the next week with another emerging market economy. Akhil Prayumurthy, Financial Market Professional.